So it's 2025 and you have a pension. Wow, we didn't think this would still exist. Less than 20% of people have a pension nowadays, and so you are considered in a unique crowd of people that still have this. And yes, there's still pensions being offered, but it is definitely not as frequently as they used to be offered. It was close to 50% of people had a pension back in the day. Now it's less than 20%, and that number is going to continue to decline is what we're expecting as time goes on. So if you have a pension in 2025, you're probably lacking information or lacking resources to make the best decisions. And so we hope this channel can help you, but specifically this video today, we're going to walk through all the things you need to know in having a pension in 2025 and how to best plan for this moving forward.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Joe Schmidt, CEO and founder of Peak Retirement Plan. I hope you enjoy that intro. I always have fun with it. You know, Joe knows retirement. And yes, I do not know pickleball. We have clients that always try to invite me out to come play pickleball with them. And so maybe someday we'll have a tournament and have all of you guys out and enjoy that. So if you enjoy pickleball, maybe put in the comments below, maybe talk some trash to see, to me to see if you can motivate me to start playing. So, but anyways, as you know on this channel, we talk about the 2% club, those with pensions, those with $1 million or more. And again, it is so rare. That's why we call it the 2% club, because only less than 20% of people have a pension, less than 10% of people have over $1 million. When you combine those two percentages, that's 2% of the population. So as we're going to talk about in the video today, you have some more unique considerations that you may not be able to see out there. And so one thing we always try to explain is, when we talk on these videos specifically, you have to understand how much different that we are talking than someone who doesn't have a pension, someone who may not even have $1 million. For example, if you have $500,000 and no pension, and that's your retirement and Social Security, you're not going to need a lot of the different types of strategies we talk about. One big one is a Roth conversion as an example. Well, you may not need to do a Roth conversion because when you're required to take out money from that $500,000, even at 73 or 75 due to RMDs, right, required minimum distributions that the government force you to take out, then that could still remain under the standard deduction. That could still allow you to have Social Security tax-free. If you're a married couple, the standard deduction's up to $30,000. And so, those are the things that hey, the type of planning we're recommending to this person may not be best for this person. And again, remember, if you're in the 2% population with a higher income, higher net worth, you're going to want to look at different strategies a little differently than maybe your neighbor, your friend down the street who doesn't have the same situation as you. They may have still been a diligent saver, even if they have $1 million. But remember, with a pension, it adds so much value to your net worth. And so that's what we're here to educate about, to make sure that you don't take this lightly. Taxes are probably going to be the biggest expense in your retirement. And so we want to make sure we're taking advantage of that right now in 2025. So let's break this down. So one of the things we need to worry about if we have a pension in retirement is what's called those required minimum distributions. So I just walked through and gave you an idea for someone who doesn't have as much saved. But if you do have $1 million as an example and a pension, then we know that RMD is going to be about 4% that you're going to be required to take out at age 73 or 75. And so that can be a significant amount you're expected to take out. But remember how this works. Your pension is guaranteed income. That's going to be taxable. Your Social Security could be taxable. That's based on your income. It's based off what's called your provisional income. The higher your income, the more tax you have to pay on your Social Security. So what's happening with most of the clients that we work with pensions, especially if they're moderate pensions or higher, they may have to force 85% of their Social Security to be counted as income. So you have your pension, you have your Social Security, and then you have your RMD on top of that. That's going to put you in probably a higher income situation than most people out there. And so you really want to make sure you're planning for this. And again, remember, you're unique with that pension as we've been talking about. So how do we plan for this higher RMD? What does this look like? Well, one situation you can look at, which a lot of our clients really like to explore, is retiring early. And understand, with a pension in 2025, less than 20% of people have it. This may be more of a realistic opportunity for you than others. And so when you're around the dinner table with all your friends and your friends say, I'm working until 65 to get Medicare, or I'm going to work a few more years because, I don't want to withdraw all my money for my investments. You could probably sit there with a little grin on your face and say, well, I have enough to afford healthcare if I retire early. Or maybe my employer offers healthcare until I retire, until 65 when Medicare is offered. Or I'm not going to have to take out from my investments because my pension is so large. And a lot of people can have pensions of 60%, 70%, or even 80% or so from their income, from their final average salaries. And so that can be a very generous amount that they're living on that may be able to cover all their expenses. Maybe their house is paid off. Maybe they have been able to be frugal over all those years and now in a position where now they can splurge a little bit more. But anyways, that's a realistic idea. And so one thing to consider if you do have a pension nowadays is you're a candidate to potentially retire early, and maybe you start to withdraw from your investments earlier and splurging a little bit in what we call the go-go years, right? Maybe your pension covers what we call your paychecks. That's all your needed expenses. And then maybe your investments are your paychecks. And then you can reasonably take out of those for whatever is going to be efficient for you, so you don't end up running out of money or taking too large withdrawals where you're putting yourself at risk in case you ever need that money. Or maybe your pension doesn't have a cost of living adjustment that you want to plan for as time goes down the road, because that can be another concern to worry about if you have a pension nowadays. Is a lot of pensions are either going away with the cost of living adjustment or they're reducing them and not keeping up with inflation. And so not a huge concern with how beneficial a pension is, but definitely could be something that can come back to bite you in 10 to 20 years if you're not planning for that. We all know that inflation over time, if just a 3% inflation rate, if you need $100,000 to live on now, in 20 years, that may be $200,000. And if your pension stays flat, you're going to have to come up with those extra expenses from your investments. But understand, you're positioned well because you may not have to take as much out from your investments. Maybe you're only taking out 2% from your investments early on in retirement, and maybe later on you need to take out 6%. Well, maybe all that offsets, and so that you can reasonably take out enough to not have to run out over a period of time, because you've probably all heard of the 4% rule. Some will prove it right, some will prove it wrong. It's a good guide to understand, though, of what you can be considering there. So again, maybe you're staying under the 4% rule, and then, maybe you decide to take out more later on. Or maybe you say, I want to take out more than 4% now to go splurge and enjoy. And then knowing I'm probably not going to have as many expenses as time goes on, and spend less than 4% or don't spend any at all. And so those are all realistic considerations for you to think about. But back to the conversation of these required minimum distributions is, if you retire earlier, if you take out and withdraw from your IRA now, then you're not going to have to force yourself to take out as much later on. And so this could allow you to almost pre-spend those RMDs because you're going to have to take them out regardless. The government forces you to do so. So might as well enjoy it while you can. One of the biggest regrets we see people with pensions that they tell us is, I wish I would have done more. I wish I didn't say no as much. And so if that's you, understand you've only got so much time here. You are in a great financial position. These things are things that you can realistically do. And I know that's hard for you because you've probably been that Midwestern millionaire all of these years. You've probably been that diligent saver, probably best saver, worst spender. But again, now it's time to flip the switch. And now you have permission, the opportunity to do so. And I'll tell a story about my mom. I mean, you've probably heard me tell this before. She loves blueberries, and she won't buy them unless they're on sale. I have to consistently remind my mom, you can buy blueberries now, right? You have the capability of doing so. But a lot of times with her, it's just innate. It's something that is human behavior for her because she's gone so many years. She had a family of seven. She had 6 siblings, and so there's a lot that she didn't get growing up. There's a lot that she had to work hard for and see the value of having, and she wants to always maintain that for the rest of her life. So I always just have to remind her, if you want to continue to do that, if that's what gives you joy, then you can. But you do have the ability to splurge here and there to make sure you can enjoy this retirement to the best of your ability. So, and if you do have a pension in 2025, remember too that Roth conversions can be a really advantageous opportunity for you. So as we used the example earlier, if you don't have a pension and you have less than $1 million, you may not want to look at a Roth conversion. There's a majority of the population where a Roth conversion may not make sense for them. But when you start to have a higher income, or you're expecting your income to be the same or higher in retirement, that's when a Roth conversion could start to make sense for you. And remember, with a Roth conversion, it all depends on what is your tax rate now, and what do you expect your tax rate to be in the future. And so some of that is unknown. We don't know what future tax rates are. And that's why we typically don't recommend everyone to convert every dollar they have. We typically recommend small amounts over time. And so those small amounts over time can allow us to be strategic, and maybe instead of having all of our money in tax deferred and very little or none in tax free, like we see with most people who first come to us, when they want to work with us. Maybe we want to look to have more of a balance so we can have something called tax diversification. And that simply means the ability to pull out from different types of investments that have different tax consequences. So for example, maybe you're in retirement and you want $50,000 to withdraw. Well, if you have all your money in tax deferred, that's going to be a big tax bill that you're going to be responsible for. That could cost you to pay more in Medicare premiums. That could force you to pay more in Social Security tax. You could be in a higher tax bracket. It could lead to a lot of concerns. But what if we also have this bucket of money in Roth or tax-free, where maybe now we could take $25,000 from each, lessen the tax burden? Or maybe we can take it all out from the Roth if it's a really high tax rate environment that year we need the cash. And so we like having a balance so that we have the freedom. Right now we consider it to be a relatively low historical tax rate environment. And so now would be a great opportunity typically to take from the tax deferred. Take it out while taxes are lower. Typically with clients right now, we're trying to let the Roth grow and be ready to use it down the road or be there for the spouse due to what's called the widow's penalty, which is something we'll talk about as well in this video here today, where you could pay nearly double the amount of taxes for a spouse. So that may be better for the spouse to take the Roth versus you while you have the married filing jointly rates now. And so those are all considerations. Or maybe your child is a high income earner and they're going to be receiving an inheritance of potentially their highest income earning years. And that's going to be on top of that income. And they're going to have to withdraw it over 10 years, which is going to cause a big taxable event. And it's going to be an unknown tax rate. So we're kind of planning blindly of what that impact could be. So again, these are all the considerations of why a Roth conversion can make more sense for someone like you. But also the Roth conversion may not make sense for you. For example, they just use your children example. Well, what if you have 10 children or 5 children and you may not be leaving them as much wealth. And so if you only leave them $100,000 each or $200,000 each or whatever the case may be, that over 10 years may not be that much of a tax burden. If you do expect them to not have a pension or they're going to, there's not as much of an age gap and maybe you live till 90 and they're 65 or 70 at that time and they're retired with no pensions. Well, maybe you'd rather have them pay the taxes. So you can see there's a lot to consider with all this, but it typically does make sense to have a small amount in a Roth at least to have that diversification we talked through. But you do want to be thinking even further beyond that as you do your planning here of what makes sense. And everyone's situation is going to be different. That's why we never tell everyone to go do a Roth conversion. It's why we don't recommend any cookie cutter plans to clients. Everything we do here is very tailored, and we'd ask that you do the same for yourself. And so as I told you earlier, we're going to come back to this widow's penalty concept. So this is something we're really concerned about people with pensions. And so especially depending on your situation with the pension. So if you've elected, for example, 100% survivorship option of that pension, that means your spouse is going to carry that over, and they're going to carry that over at single tax rates as we just explained. And so that's ultimately going to kick them up to a higher tax bracket. It's going to cause some other things to become an issue, Medicare, Social Security, things like that. And so that's where it could be advantageous to have those Roths or to start planning more efficiently from an income standpoint of what to do. We also have to understand that if you have Social Security, the spouse is going to drop off the lower of the two, but get to keep the higher of the two. So they're going to get to keep a portion of that Social Security, but that could all play a part in how you decide and when to take Social Security. Maybe you delay it so that your spouse can get the most if you pass away. So you can see how all these decisions that we're making leading up to this point can be overly advantageous for you. But again, if you are going to pass that pension along, make sure we're planning for that widow's penalty where they could pay nearly double the amount of taxes. And some of you may be in that decision-making mode of, should we take the survivorship option or not? And I want to tell you, make sure you run your numbers. I'm not telling you not to take it. I'm telling you to make sure your spouse is covered no matter what options you take. But there is lots of options. You could look at 100%. Maybe you only need 50% and your spouse is more than covered. That would allow you not to have to pay as much for that survivorship cost, get more in your pension, could allow you to do some more fun things throughout retirement or leave more of a legacy or whatever that may be. Or maybe you look at getting some life insurance where you cover all their goals and then maybe your spouse predeceases you. Well, this money could still be left behind to kids, or you could cash out the policy. There's all these different options. So the key though is just run your numbers. We have proprietary software that we run for our clients that they absolutely love because they don't want to worry about making this wrong decision knowing it's irreversible. And so this is something you want to spend some time on and make sure you get that right. And so my last point on this, if you have a pension in 2025, we've already talked about enough how great of a situation this is. My last thought is just make sure you're being purposeful. What do you want the next half of your life to look like? You've gone all these years, you've worked 20, 30, 40 years for the same company, you've been grinding it out, you've been blood, sweat, and tears. And now you have the opportunity to get to steward it the way that you want to over the rest of your life. And so whether that's spending it and enjoying it, we have clients that go on some pretty crazy trips. We have a client that just went on is going on a $80,000 2-week African safari. We have another client who did a 4-month cruise at 100 different ports, and that was about $75,000. So you can spend a lot of money on trips if you've been in this situation. We also have clients that say they can do it more efficiently, and maybe they just go across the sea and do a $10,000 to $20,000 trip. But whatever it may be, that could be an opportunity for you. Or maybe it's to spend more time with the people that you love, and maybe you're doing vacations with them, or maybe you'd rather see the impact through giving them some financial support. Maybe it's to start to beef up their retirement accounts, or to start to help them buy a new car, or help them with college education, whatever it may be, to set them up for success. And so we want you to start thinking about those things, and that's where you could either spend it as I'm talking about, gift it like I'm talking about to loved ones, or give it. Maybe it's a charity that you want to give it to. But just remember, because you have this pension, you have more opportunity. You have more opportunity to do these types of things that others may not be. Those others may be more concerned about running out. Most of the people we work with aren't worried about running out of money. They're worried about how do they maximize their time and make sure that they can live out and fulfill their requirements. And there's a lot more responsibilities with the type of planning with this to maximize and optimize it. So that's why a lot of clients work with us, is to make sure they can get all the savings so that they can spend, give, and gift most efficiently throughout their retirement years and when they pass away. And so that's my hope to you, is that that's you and you get the best planning here moving forward. And if you are looking for the type of planning that we talk about, you have a pension and you want to make sure that you're working with a team who understands you, who understands how to work with people with a diligent saver and a pension, then we'd love to explore working with you here. And so if you want to schedule in time below, you've maybe watched our videos for a while, then feel free to do that, and we could see if we could be a good fit to serve you here. So with that being said, that's all I've got in today's episode, and we will see you on the next one.